Hey everyone, it is Julie here with TipRanks, and today we're taking a look at two strong buy top analyst stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here and TGI Friday. Today we're taking a look at two stocks that not only have unanimous strong buy ratings, they've also picked up recent ratings from some top ranked analysts. So we're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. We found today's stocks using the top analyst stock page over on TipRanks. Found right at the top of the Ideas tab, this top analyst stock page will give us a list of companies that have been picking up ratings from 5-star analysts recently. And just before we get into our stocks today, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. And don't forget to download the TipRanks mobile app if you want to access all your favorite investment research tools on the go. Links are in the description down below. Let's get right into our two strong buy stocks. First on the list today, we're taking a look at a company called Lease. They trade under the ticker AL, currently priced at $48.11 per share. In the past year, their stock has grown 12.83%. In the last 3 months, fairly flat, up 0.5%. You may have been able to guess from the company's name, but Lease is a leading aircraft leasing company. They buy new commercial aircrafts from manufacturers like Airbus, Boeing, and Embraer, and then lease them to airlines around the world. They also offer other services including aircraft financing, remarketing and sales, management, and fleet management for aircraft portfolio owners and investors. They have a global customer network with over 120 customers across 62 countries, and as of March 31st this year, they owned 472 aircraft. Lease does pay a quarterly dividend, and they've been growing that dividend for the last 11 years. It currently sits at 21 cents per share on a quarterly basis for a dividend yield of 1.81% and a low payout ratio at just 16.6%. They shared their Q1 earnings report back near the start of May. Now, they did see revenue grow slightly year over year, but both earnings and revenue fell short of estimates. For their first quarter, they reported earnings per share of 87 cents, which did fall 7 cents short of estimates. They said the reason for the decrease year over year was higher interest expenses. Revenue came in at $663 million, and that did increase 4% year over year, but did fall short of expectations. They highlighted that they have placed 100% of their committed order book on long-term leases for aircraft delivery through the end of 2025 and have placed approximately 63% of their entire order book delivering through 2029. Management commented that with aircraft in short supply and values rising, we benefit from continued fleet expansion and sales activity in an industry backdrop that remains positive. We see this environment continuing for near to medium-term future. Just a couple of days ago, a 5-star analyst, Ronald Epstein from Bank of America Securities, reiterated their buy rating on the stock, saying that the future looked promising. They said that while there are short-term challenges due to OEM delays affecting aircraft deliveries, this situation is seen as a temporary setback. Epstein believes that these delays will eventually lead to a long-term advantage as they create an environment where Lease can leverage its valuable backlogged orders and favorable contracts to achieve higher lease rate premiums. This potential for increased profitability in the future underpins the positive assessment. Epstein is one of 5 analysts that all have a buy rating on the Lease stock. And that strong buy consensus comes with an average price target of $58.40, which would imply an upside potential of 21% from current prices. Looking down below, we can see his recent rating here. It is our high-end price target with an upside of 49%. Our low-end price target does come from JP Morgan at $54 for an upside potential of 11.8%. Our second stock today is a company called Avient. They trade under the ticker AVNT and are priced at $44 per share. Their stock has climbed just over 9% in the past year, and in the last 3 months is up 5.64%. Avient is a premier provider of specialty polymer materials, services, and solutions. Originally created back in 2000 under the company name Poly1, they're now a leading formulator of specialized and sustainable material solutions that transform customer challenges into opportunities. Their offerings include specialty engineered materials, performance fibers, advanced composites, and color and additive systems. They were among the first companies in the plastics industry to establish global policies aimed at reducing and eventually eliminating the use of heavy metals and phthalate plasticizers. Their global network of product stewardship and regulatory compliance specialists include experts on regulations covering food, beverage, drugs, cosmetics, medical devices, consumer goods, toys, and more. Avient is also a dividend payer with dividend growth dating back over a decade. Their current quarterly dividend is 26 cents per share for a dividend yield of 2.43% and a healthy payout ratio at 41%. And the company did post both an earnings and revenue beat for their first quarter back on May 7th. For their first quarter, Avient reported earnings per share of 76 cents, beating estimates by 7 cents per share. And they did see this increase 21% year over year, driven by improved margins from lower raw material costs and favorable mix. Their first quarter sales of $829 million did drop 2% year over year, but did come in ahead of estimates. Their president and CEO said that it was a positive start to the year and that their performance was supported by strong demand for their Dyneema fiber technology used in personal protection applications and raw material deflation. Following that Q1 earnings report, we did hear from a couple of four-star analysts from Seaport Research and Wells Fargo, who both increased their price target on the stock. The Seaport Research analyst said that the company had a solid start to the year and that the firm is encouraged to hear the company is picking up some market share and remains positive on the company's long-term growth opportunities. The analyst at Wells Fargo cites encouraging demand signals in key end markets and volumes turning positive near term. The Avient stock does just have 4 current analyst ratings, but all 4 do come in as a buy. And the average price target comes in at $52.25, implying an upside potential of nearly 19% from current prices. Looking down below at our recent analyst ratings, on the low end we do have one from Oppenheimer back in April with an upside of over 11%, and our high-end price target comes from Seaport Global at $55 for an upside of 25%. So that is a quick look at 2 top analysts' strong buy stocks. Let me know your thoughts on these companies in the comments down below and if they were on your radar before and what you think of their future potential. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are looking at. So please make sure you always do your own research and due diligence. Thank you guys so much for watching. I hope you have a wonderful weekend, and I'll see you back here next time.